Welcome everyone to the London School of Economics and Political Science. My name is Dimitri Vayanos and I'm a professor of finance at the Department of Finance and the co-director of the Financial Markets Group. I'm very pleased to welcome all of you at the Old Theatre tonight. So today we will hear the fourth annual lecture in honor of Charles Goodhart. Let me say a few words about Charles, and then I will say a few words about Hyun, the person who will, our speaker tonight. So Charles is an eminent economist who was appointed to the Norman Sosno Chair of Banking and Finance at the LSE back in 1985 until his retirement in 2002, when he became emeritus professor. Actually, this is far from being his retirement from doing economic research and for teaching us about many, many interesting things in economics. It was just a formal retirement. He was elected as a fellow of the British Academy in 1990 and awarded the CBE in 1997 for services to monetary economics. Very importantly, Charles helped found the Financial Markets Group at the LSE together with Mervyn King in 1987. He has an illustrious career not only in academia but also in policy roles. He has served as a monetary economist at the Bank of England, becoming a chief advisor in 1980. He he served at the Hong Kong Exchange Fund Advisory Committee in the 90s and gave them very important advice about their monetary policy framework. And that same, in 1997, he was appointed one of the 4 independent outside members of the Bank of England Monetary Policy Committee. Charles has written widely and is an extremely respected voice on matters relating to monetary policy, central banking and macroeconomics, and more recently also on demographics. He is a model for all of us about how to combine deep economic thinking and insights with being extremely policy relevant. And we are very, very happy to have this lecture in honor of him. So delivering the lecture, we can now come to our speaker, is Hyun Shin. He's an economic advisor and head of the Monetary and Economics Department at the Bank for International Settlements, the BIS. Before joining the BIS, he was the Hughes Rogers Professor of Economics at Princeton University. Before that, he was our colleague at the LSE, at the Finance Department. And before that, he was at Oxford. Hyun is an intellectual leader in the fields of banking, in international finance, monetary economics, game theory, global games, you name it. So topics on which he has published widely in prestigious academic journals as well as in the policy area. Hyun's, one of his areas of his recent focus has been to develop the BIS work agenda on digital innovation and the financial system. And he was part of the BIS management team that developed the BIS Innovation Hub and served as an interim head at its launch in 2019. He has also served as a senior advisor to the Korean president, taking a leading role in formulating financial stability policy in Korea and developing the agenda for the G20 during Korea's presidency. Hyun is an excellent choice for the Goodhart lecture. Like Charles, he combines deep economic insights and very well respected, highly respected academic research with policy relevance in his role as, especially as chief economist of the BIS. So, Hyun, over to you. Let us welcome Hyun.
Well, thank you, Dimitri. It's great to be back in this room, actually. I mean, LSE holds so many good memories for me. It's wonderful to be back. I think I spent the most productive time of my career when I was here, and it's a double pleasure to deliver this presentation in honor of Charles, my friend and mentor. I mean, pretty much everything that I know was learned from Charles. So what I've done is to put together a few slides on changes in the global financial system. And, while I wait for the slides to come up, So I'll say a few words about the structural changes in the global financial system and some new trends that have emerged that I think would be very important for us to bear in mind in trying to understand events in financial markets right now. I think the backdrop is that the great financial crisis was really a watershed event. It set in motion some forces that I think have really defined where we are today. And let me begin with this chart, which is the way that essentially the traditional banking system, especially the broker-dealer sector, has actually evolved. What this chart shows is the total assets of three sectors in the US: households, non-financial corporates, and broker-dealers. It's all normalized to 100 at the beginning of 1990. And just track, how large they became. You see that the yellow, which is the security broker-dealer, really grew much faster than the other sectors in the economy. And when Charles and I were writing the Geneva report on banking regulation, this was just after this point. Leverage that total assets had grown tenfold relative to 1990. And then, of course, it shrank very fast thereafter. The other sectors have grown in the meanwhile, and now they're pretty much again at keeping pace, having had this very big round trip. So one of the things that we worked on when Charles and I wrote the Geneva report was the importance of keeping track of leverage in the regulated financial sector. If you can keep track of that, you would go a long way to actually measure the risks and to see the extent of risk-taking. If we look at the leverage of the sector, of course, that actually keeps, it has a roughly similar pattern to the total assets, but of course, equity has grown in the meanwhile. So leverage has stayed low throughout. So if you look at this chart, you might think, well, it means that the intermediation is not happening through the traditional broker-dealer sector anymore. So where has it migrated to? I think that's a very natural question that we can ask. And it, I think, motivates the structural change discussion that we'll be having. So to simplify, before the GFC, we could say the focus was very much on private sector claims, especially mortgages. And banks and broker-dealers were really very much at the center of the story because it was the assets that were held on balance sheet or warehoused through the special purpose vehicles. That's where all the action was. That's where all the risk was residing. And the lesson that we learned looking back was, well, we should have been keeping track of this. And when leverage reached 50, we should have sort of noticed that there was something unusual going on. And so why don't we learn that lesson, and going forward, let's make sure that we keep track of these balance sheets. I think that was the lesson that we learned. And subsequently, that lesson was incorporated into the various financial stability monitoring exercises at central banks, at the FSB. So this was the story. Now, what's happened since, though, is that there's been this rather profound structural shift. So rather than private sector claims, at the center of the financial markets these days are sovereign bonds. And it's really the claims on the government rather than the claims on the private sector that has really taken center stage. It's still financial markets, but the intermediaries have also changed. So it's clearly not the same players that we had before, because they've obviously shrunk. But But what I'm going to say later is that this shrinking, this apparent shrinking, should not be taken at face value. To some extent, there is also an accounting element here which obscures the true nature of the intermediation. But anyway, this is a theme that I'd like to explore today. So why do I say that it's the credit to the government that's really taken hold? Well, this chart is a weighted average of the credit to the private sector, the private non-financial sector in blue, and the credit to the government in red, again normalized to 100 at the beginning of 2000. And it's weighted by GDP, PPP GDP, of a number of economies, including the largest ones. And what you see here is that, exactly as we saw, before the GFC, it was the private sector claims that were growing faster. But then after the GFC, and they cross exactly at 2009, it's the government claims that have grown much faster. And you see the big pickup here during COVID. Of course, that's when government spending really kicked in hard, and this is when, of course, a lot of the central bank operations also came in. If we look at the two largest economies, the US and the euro area, here the solid lines are the US, the dotted lines are the euro area. You see that it's really primarily, it's the US government bonds that have really grown really very, very fast. If you look at the euro area, the red dotted line for the euro area is actually pretty subdued. So in spite of what we say about, the fiscal situation of the euro area is very challenged, and this is something that we need to keep an eye on. In fact, of course, they started off with higher debt to GDP levels than the US did, but it hasn't grown as fast as the US has. And it's very much a kind of a few economies, one of which is not the euro area. So the euro area has not been part of this. If we look at the instruments, there's also been a shift. So as you would expect, there's been a shift away from loans towards market instruments, to marketable securities, to bonds. And again, the blue line here is the loans for these economies. And the red is the government bond series. The purple is the corporate bond series. It's the non-financial corporate debt security series. You see that, yes, corporate bonds have also grown, and it's grown faster than loans, but again, it's the government bond sector which has grown fastest. So this is a rather complex chart, but the message here is, again, it's the US. And for the euro area, in fact, the corporate bond growth has been quite lively. It's been quite a bit faster than the government bonds. Now, why does that matter? Well, the issuance needs to be held by someone, and part of it is held domestically. But as we've seen in the last month or so, what's happening in capital markets is very much a global story. It's very much a global story where investors from all over the world are holding government bonds, issued wherever they are, especially in rich economies where you have large institutional investors, pension funds, insurance companies. They have obligations in domestic currency to their policyholders and to their beneficiaries, but because of their very large asset size, they have to have a globally diversified portfolio. And that means that they have assets in many different currencies. So it turns out that the foreign exchange market is absolutely essential. It's a crucial player in this story. And I'm going to focus on this for the bulk of this talk. And in particular, the foreign exchange swap market. Now, let me spend a couple of minutes on what they are, so that we can sort of fix ideas. So think of an FX swap as a collateralized borrowing operation. Suppose I want to invest in some US dollar securities, but all I have are euros. Well, one way that I could do it is I can pledge some euros as collateral, borrow dollars, and use those dollars to invest in the US dollar securities. And then when it comes to the maturity of that collateralized loan, I would just roll it over. I would just update. So typically, FX swaps are short-term arrangements. So they are certainly much less than 1 year, sometimes even a few weeks, but typically not longer than 3 months. So here's an example. So there is a US dollar provider, let's say, so this would typically be a large US bank. And there's a euro provider, let's say a euro area pension fund. And on the contracting date, the euro area pension fund delivers some euros at the current spot rate and then receives $100. And at the same time, they agree that at a fixed point in the future, they would reverse that transaction at a pre-agreed exchange rate. So the exchange rate that you would unwind that transaction is agreed at the contracting date. That's called a forward rate. And I'll come to forward rates later. And this is a very simple kind of operation. So you might think, well, why would anyone want to do this? Because you're just giving one currency, receiving another, and then you're reversing that. Why on earth would you want to do that? Well, symmetric. So in contracting terms, this is a completely symmetric arrangement. But in economic terms, one side is borrowing one currency for use elsewhere. And because of the importance of the US dollar, it's typically the US dollar borrower that is actually, that's the economically more meaningful leg of this transaction. So what does the balance sheet look like with this, with this transaction? And this is important because this goes to my point earlier about the importance of accounting conventions and why we shouldn't look at those charts that I showed you about the broker-dealer sector at face value. So imagine that we have a euro area investor and has some euro deposits. So that's the initial situation. And then you enter into the swap. So remember, after the swap, what happens is that euro portion, so this blue portion suddenly becomes a green portion because now you have cash on, you have US dollars, you have a US dollar deposit on the asset side. And then there's an off-balance sheet obligation. So because you agreed to unwind that transaction, so the forward leg of that swap is showing up as an off-balance sheet transaction. Now, although this is a collateralized borrowing operation for all intents and purposes, an FX swap is not counted as debt. Even though you're actually liable for the full face value, the full notional value of that contract, because it's an off-balance sheet, obligation, the accounting convention is to treat this not as debt, but simply off the balance sheet. So what this means is, if you're a bank and you've provided this kind of operation, it doesn't show up on your balance sheet as debt, and therefore it doesn't count towards your Basel III leverage ratio. It doesn't get picked up in capital flow numbers because capital flow numbers are typically derived from balance sheets. And so when I showed you that chart of the declining heft of the broker-dealer sector, to some extent that's due to the if you like, treating this as excluding this from the calculation of debt. The other thing, which is, I think, very important to understand, and this is something that Charles taught me, is that money is issued by banks, right? So so if you have deposits in a bank, that's money. And as Sarah knows, there's a singleness of money, which means it doesn't really matter what form of money you have in the economy. It's really just as good for payment, whether you have commercial bank money or whether you have a balance on your payment app or whether you have cash. What FX swaps do, actually, is to make money fungible across currencies. So you wake up one day, and suddenly the blue euros that you had suddenly have turned into dollars. And so one day you had euro cash, next day you have dollars as a deposit, and it's money. This is why the banks are so important in this operation. It's just that there's this off-balance sheet obligation that, of course, the two parties keep track of, but it's not counted as debt. And of course, with that dollar cash balance, of course, you're going to do something with that. And typically, the story that I'm going to be focusing on today is, with the dollar balances that you have, you're going to buy a US dollar security, maybe a US Treasury security, corporate bond. And so this would be the final, this would be the destination after those sequence of transactions. So the euro holding investor has ended up with a US dollar security. But any kind of currency mismatch is offset by the fact that you have a dollar liability as well, but it's off balance sheet. Now, although there is no currency mismatch, there will typically be a maturity mismatch because your dollar obligation is coming due in a few weeks, in a couple of months, whereas your dollar security is probably a long-term security. And sometimes it could be, depending on what it is, it could be somewhat illiquid. So if you need to unwind this, you may find that it's less easy than you think. Now, why do I mention the accounting? Well, it's because this is a very, very large market. So the BIS compiles data on FX swaps. And the latest number, these are semi-annual series. So every 6 months we compile the date. We have the new observation. We have $113 trillion of outstanding FX swaps. So it's swaps and forwards, but I'll just say FX swaps. So 113 trillion, if you think about it, is a pretty big number. Yeah. It's actually, if you think about any asset class out there, this is several times larger than that. One of the things we do is to show who the counterparty is in the FX swap. Now, of course, we get the data from the dealers, so one leg is always the dealer. The question is, who is on the other side of that FX swap? The yellow is when both sides are dealers. The blue is when the other side is a non-financial actor. So it could be an exporting firm, the textbook example of currency hedging, etc. But the really interesting part is the pink. So these are what's called other financial institutions. So other than the dealer banks. So these could be non-dealer banks, but typically they are asset managers, they are insurance companies, pension funds, the market players that we've come to know very well. And that part is the one that's grown fastest. So I showed you that 2009 was the watershed, right? That's when everything changed. Well, from 2009 until now, that portion has basically tripled in size. Yeah. Global GDP has grown something like 70%. This is a very, very rapid increase. And all of that is off balance sheet, and therefore it is not counted on any of the kind of balance sheet tracking sort of surveillance tools that we have. So one of the lessons actually that we took from the GFC was, let's keep track of balance sheets, especially when they're growing very fast. Unfortunately, this is one of the lessons that we have to unlearn from this episode, because this is not showing up on the balance sheet. Even though economically these are, it's a collateralized borrowing operation. And it's big. But it's big because the capital markets are also big. And if we look at the currency composition, again, it's the US dollar, which takes the lion's share. So if we take off the yellow, which is the dealer-to-dealer part, just look at the blue and the pink, the pink is like 60 trillion in total. Well, it's something in excess of 50 trillion is accounted for by the dollar on one side. Now, why would that be the case? Well, it's because, of course, there is a great deal of portfolio flows across economies. And so what this chart shows, this is one of the hexagon charts that we used, to show the increase in the lending, before the GFC. But this is the comparable hexagon chart for portfolio flows. And in particular, what this shows is the change in portfolio holdings cross-border between 2015 and 2023. So these are changes. So the red here indicates declines. The green indicates increases. What's interesting is, if you look at this chart, there is only a very loose relationship with the current account and the net positions. Portfolio holdings are the gross positions. So in particular, the largest investors in US securities are actually Europeans. China is over here. Japan is over here. So, obviously, they also have a large position, and it's increased somewhat. But the gross positions tend to be very much between the advanced economies. So this is very much the same lesson as the story about the GFC. If we look at the banking flows during the GFC, there was this round-trip trade from Europe to the US and then back to Europe. So European banks were raising dollar funding in the US to invest in mortgage-backed securities. And so you had this round tripping. And of course, between the US and Europe, the current account balance was close to balance. But in fact, that's where the big gross flows were, and that's what actually eventually unwound. And something similar is also happening here. Now, why am I showing the changes rather than the levels? Well, one of the quirks of the international data on portfolios is that reserve holdings are not part of these measures. So central bank reserves are not included. Now, it's still okay to use this because if we look at the composition of portfolio flows between official holders and private holders, so the pink are the official holders of US Treasury securities. The blue is the private holders. The increase since around 2012 has all been in the blue, in the private holders. In fact, if anything, the official holding has actually declined somewhat. And the blue line shows the proportion of the non-official holders, and it's now close to 50%. So when I show you this chart, these green lines pretty much are a faithful reflection of the total flows, including the official flows. So I think the point to take away from this is, we read a lot about the importance of current accounts, about the net flows, and it comes from, I think, a more macro approach, Ricardo. I think, in macro, of course, capital flows are the residual to consumption and investment decisions, and I think that's where this intuition really comes. But if you're interested in financial conditions, how things actually move, it's important to look at the gross flows, and that's, I think, the lesson that we can draw from this. So here are some of the things we can learn. So what do we know about the capital inflows into the US? Now, typically, when we talk about capital flows, this is an emerging market topic. We say, well, capital flows go into the emerging markets and they sort of, rush out during stress. Well, let's look at the portfolio inflows to the US, because I think that's really probably the most important issue out there in capital markets right now. Well, FX swaps turn out to be very useful in explaining portfolio flows into the US. So the US Treasury publishes the tick data in portfolio holdings. So this is the growth rate of portfolio flows, of foreign portfolio flows into the US. And on the vertical axis, it's the growth of the FX swaps. And it does a passable job. Now, of course, we can refine this further because sometimes the hedge ratios are lower, sometimes hedge ratios are higher. This is very much the topic of conversation right now, because the question is, how high are the hedge ratios? If you're unhedged and you're exposed to exchange rate movements, you may find that you have to join the scramble in hedging ex post. So hedge ratios will tend to be lower when the dollar is strengthening. Why would you hedge when you can win on both the exchange rate as well as the higher yields? It's also going to depend on the cost of hedging, and cost of hedging depends on the short-term rate. When short-term rates are high, cost of hedging is also high, and then hedge ratios would actually be lower. And so if you control for that, it's a very simple control for this calculation of the slope of the yield curve between the two, for the US and for the investing country. You get something that fits much better. This is something that I'm currently working with some BIS co-authors. It's also true currency by currency. So we can look at the tick data and look at what happens to euro area holdings of US government securities, and then look at the changes in swaps with euro on one side. We have exactly the same relationship in euros and euro area flows to the US. This is for Japanese holdings with FX swaps in yen. This is UK holdings and FX swaps in sterling. And the last one is Swiss. The portfolio flows from Switzerland and the change in the FX swaps. So there is a lot of information here. There's a lot of information in the FX swap data on portfolio flows. Now, what this also suggests is that during periods of rapid capital inflows, we know that that's going to raise asset prices, it's going to tighten spreads, it's going to loosen financial conditions. That's exactly what we find. So if you take a measure of financial conditions, and here I'm just showing you the Goldman Sachs Financial Conditions Index, just the annual change of that index, and the way that they measure it is when the red line goes up, this is when financial conditions are tightening. There is this negative relationship between FX swaps and financial conditions. So because FX swaps are associated with portfolio inflows into the US, this tends to loosen financial conditions in the US. And conversely, when FX swaps really decline, this is associated with portfolio outflows, and that's going to tighten financial conditions. So we have this triangle now. So the story that I've told you so far is if we can track FX swaps growth, it's going to tell us something about portfolio flows, but it's also going to tell us something interesting about financial conditions. So there is this triangle where, although it looks very esoteric, it actually tells you a lot about financial conditions and what's happening in the market. So let's just plot that triangle. So the yellow is the annual change in the Goldman Sachs Financial Conditions Index. The blue line is the equivalent FX swaps, and the red line is the portfolio flows. And we see that there's a very good fit between the FX swaps and with financial conditions, and also with portfolio flows. Now, if you dig into the financial conditions index a little bit further, it's the way that they construct it is to take 5 variables. It's the short rate, the long rate, there's a spread variable, it's a corporate bond spread variable, there's the equity index, and then there's the exchange rate, there's a broad dollar index. Now, when these lines go up, that's when financial conditions tighten. So what's happened recently is that these lines have really diverged. So according to some measures, financial conditions are tight. According to other measures, financial conditions are very loose. So if you're tracking the equity market, financial conditions are very, very loose. If you're tracking the policy rate, financial conditions are very tight. And this has been this has been part of the conundrum actually for central bankers. How is it that we have this, very, very loose conditions according to some measures, but tight conditions according to other measures? Well, so one thing that we've been doing is to try and see whether we can extract some patterns that make some sense. And there is a paper that's forthcoming that builds a dynamic factor model. It's like a principal component exercise. Let's take a large number of variables and see whether we can extract some common factors. And let's see what the factor loadings are and see whether we can interpret those factor loadings in telling a story about what it could mean. But it turns out that 2 factors really sort of jump out. The first factor loads on short-term rates, safe yields, risky yields, and bank rates. So when those rates go up, financial conditions tighten. So that's like a level of interest rate type of effect. But the really interesting factor is the second one. It actually loads on equities. So when equity is doing well, financial conditions are very loose. In particular, when spreads are widening, financial conditions really tighten, right? Conversely, when spreads tighten, financial conditions are very loose. And in fact, for short-term funding, it goes the other way. So it's when short-term rates are low, that you actually have tighter conditions in this, according to this measure. And this looks very much like a kind of risk appetite measure. So when we do the time series, the first factor looks like this. So according to the first factor, it was actually very tight before the GFC. And it's actually very tight in the last couple of years because policy rates are very high. When it was very loose was during the COVID period when rates were very, very low. If you look at the second factor, conditions were very tight during the GFC. It really spikes. And then actually, according to the second factor, conditions have been very loose recently. So in spite of the very high rates, conditions have been very loose. And this is reflecting this buoyant stock market, the very tight credit spreads. So there is this, we can actually extract some more information. And it turns out that it's this factor, it's the second factor that explains FX swaps growth. So I'm not going to show you that result. We do this exercise where we try and see what are the determinants of FX swaps growth. It's this factor. It's this risk-taking factor, which seems to be doing the big job. So I said that this is very relevant for what's going on. I mean, it's actually I think a very, very important story right now. So I think it's worth going through. Let me talk about ex-post hedging. So ex-post hedging is where you enter the market without much of a hedge, and then you react to events by putting on hedges after the event. So suppose that you're a euro-based investor and you had bought a dollar security without any hedging. So this is your initial balance sheet. And then you suddenly find that markets are moving in an unfavorable direction. So dollar's falling, this securities are not doing very well. Well, one thing you can do is to enter a swap. So you acquire, exactly as before, you acquire dollar deposits, you gain this off-balance sheet obligation to repay the dollar. In the story before, this investor actually bought a US security with the US dollar deposit. Now, this investor says, I'm just going to sell that in the spot market. And I'm just going to sell that and acquire a euro deposit instead. So what's just happened? I've suddenly got an off-balance sheet US dollar obligation, and that exactly hedges my US dollar security. So I've now hedged the currency risk. But you've done that by putting downward pressure on the exchange rate because you've sold the dollar and you've bought the euro. Now, when you have a situation where the hedge ratios are very low and the market is moving against you, this kind of very defensive action is, it's a tactical operation. It's not, changing your strategic asset allocation. But of course, this is something that you could, certainly think about doing in order to protect yourself against further movements. And so, do we see some evidence in that? What should we expect to see in that case? Well, we should expect to see some relationship between FX swaps and the exchange rate. That's exactly what we see. So when FX swaps go up, that's when the dollar depreciates. So you can either read this as an explanation for how the exchange rate moves, or you could do it the other way, because everything is endogenous here. So I'm just telling you the story, but obviously to get past the referee, you'd need to show much more than simply a scatter chart. But you could also tell the story by saying when the dollar is weak, this is when risk-taking is also very prevalent. There's a risk-taking channel, which means that you will also want to hedge and go into US securities. Let me finish with the yen carry trade, because this is something that, of course, was very much in the news last summer. And everyone came to our webpage, and they discovered that lending in yen was actually pretty small. It's like only $250 billion worth, which is actually pretty small, compared to the size of the trade that people were talking about. But of course, they should have been looking at the FX swap data. So here's how you would engage in a carry trade using an FX swap. You would do exactly the same as in the ex-post hedging. So suppose I am a dollar-based investor. I provide dollars and acquire yen. I borrow yen on a collateralized basis. So I have this yen repayment obligation. But what I do is I sell the yen in the spot market. Rather than holding it to meet my obligation, I just sell it. And I would typically go through the dollar, but I could now go and buy an emerging market currency, and then I can just buy the government bond in that currency. And that would be a way that you could construct this kind of trade, where you're holding an emerging market government bond, but you have a yen obligation. And this, the FX swaps in yen is actually quite sizable. It's in yen here, so I've sort of expressed this in yen, but it's around 50 times larger than the on-balance sheet numbers. Now, of course, a lot of this would be Japanese investors, long investors, wanting to buy US securities. So this is all mixed up here, but part of it will be this kind of trade. And again, we would expect to see a negative relationship between the yen and the FX swap. So when would you see a huge increase in the FX swaps denominated in yen? Well, it's when the yen is weak, because then that's when you would enter this kind of trade with a swap. And because you're selling the yen, the more people enter this trade, the greater is the pressure to lower the yen. So there's a self-fulfilling element to this as well. And again, that comes out very strongly. So Dimitri, what I'll do is I'll just conclude. So I've just given you a little glimpse of this big structural change. So, we learned a lot from Charles's contributions, and I think they're still relevant. But what's happened since the GFC is that there have been some really very profound changes in the structure of the financial markets. I haven't even begun to tell you about the short-term funding market, the repo market, and the role of the hedge funds and all of that. I've just given you a little sort of glimpse of it. But the lesson is that we really need to take the government bond market and the foreign exchange market together, because these are global markets. And the FX swap market is really the linchpin that joins the two. So let me stop there, Dimitri, and then we could take some questions.
Okay. Thank you very much, Hyun, for your presentation. So if you are welcome, you can either sit or take the questions there, whatever you prefer.
Sure.
Okay, so fine. So let's open the floor for questions. So we have some microphones going around, and so just raise your hands, and I will be. Okay. Hyun,
I think Charles has a question. Yeah.
Okay. So yeah.
So if I look in the last few weeks, Hyun, where we've had all these stories about how we don't trust investing in the US anymore and foreign investors are trying to get out, but we've had this seeming paradox where treasury yields didn't actually go up all that much, almost not at all, but the dollar depreciates a lot. One interpretation out there would be very consistent with your story is we had all these foreign investors holding these US treasuries that all of a sudden say, I need to hedge these. And as I'm trying to have a big increase in hedging, that pushed down the dollar exchange rate. Even though the treasuries are fine, I don't want to sell the treasuries, so I need to hedge. So that would fit very nicely your story, because we have seen an increase in hedging activity, or at least in FX swaps, as far as I can understand. The one thing that doesn't quite fit is that insofar as we're buying all of these FX swaps, I would expect that the banks providing them would now have to generate all these FX swaps, and I would expect to have seen an increase in cross-currency basis. A little bit more CIP deviation, because some guy has to be providing all these swaps. And that we haven't quite seen in the last few weeks. In other words, and more generally, but I think the last few weeks is far more interesting, is should I expect to see also another indicator here, which is this cross-currency basis moving with the amount of hedge? Or in other words, can you tell us a little bit about the supply of the FX swaps and the cost of supplying these FX swaps and how we can use the price of those?
So for those of you who don't know what the FX swap basis is, think of it like this. When you do the what Ricardo is saying is, when we look at this initial diagram of how an FX swap works, I said that the forward rate is going to play a very important role. Now, the difference between the swap rate, so the spot rate and the forward rate, also embodies an implied interest rate, between these two currencies. And the FX swap basis is when the interest rate that's implied by the forward rate diverges from the interest rate that's actually prevailing in the market. So somehow you can make an arbitrage profit by looking at that difference and going long one and going short the other. Typically, the dollar interest rate in the forward exchange rate is higher than the dollar interest rate that's prevailing in the financial markets. So there's a kind of dollar shortage that's embedded in the FX swap market. That's because everyone wants the dollar. Japanese insurers, Dutch pension funds, they all want the dollar, and so there is an inherent excess demand for the dollar in the FX swap market. And what Ricardo is pointing out is that that didn't really seem to play out very much in the recent few weeks. Well, I think the answer is the demand, at least a short-term demand, was actually much diminished. And remember what's happening when you have an ex-post hedging operation. You're actually acquiring dollars. So remember this sequence here. So I get into a swap, but then I sell the dollars in the spot market. So there's an excess supply of dollars, right? So that's driving the spot exchange rate down. And there's actually, for a brief period, the swap basis went the other way. It actually reversed, right? So I think that's a very telltale sign that these things do move with financial markets. I see that Sushal's here actually, and maybe we can also. Actually, he was here briefly. I mean, strategic asset allocation is typically changed only very, very, seldom. So it's maybe, and it takes a long time to actually do that. And if you speak to private sector participants, there hasn't been this wholesale shift. There hasn't been this wholesale shift. I mean, they're thinking about it, but there hasn't been this wholesale shift. And nor do we see any, big outflows from ETFs, from, the very high frequency portfolio flow measures that's given out by the official sector. So far there hasn't been this, in spite of all the commentary about, this is a new era, dollar's going to lose its dominant role and so on. That's not borne out in the hard data, except, of course, the hedging. And, the hedging, this ex-post hedging in particular, is very consistent with this, this combination of price moves, I would say.
Good evening. You spoke about in the title of emerging new risks. And clearly, in the news, together with these things we discussed today, there's the emergence of a new form of dollar, if you want, a digital dollar, in the forms of stable coins. Now, it seems to me that stable coins, if they were to be one-to-one pegged to the dollar, this hinges on the credibility of the issuer. So it's going to be tested at some point because there's an element of credit risk, clearly. So how this is going to impact your story, especially at the time when the instruments against these stable coins are hedged, which is the US Treasury, is also losing his own AAA, has been just certified by Moody's last week, last of the 3 rating agencies.
So Brunello, I think that's probably not, I think it's somewhat different from the things that I think the mic is off, right? It's probably a little bit tangential to what I was talking about. I mean, we could have had a very good discussion of stablecoins, which is a very important topic in its own right. But the issue, I think, the issue is more about the integrity of the monetary system. Will they, impinge on monetary sovereignty of some economies that, have weaker monetary systems? Yeah. I guess, if the stablecoin is properly backed, then, it's not really, there's no currency risk there because, it's a dollar-denominated stablecoin backed by dollar claims. So, but I think what you have in mind is, a different set of questions, which I think we could discuss, which are very, very important.
Thank you.
Yeah.
There's one there.
Excuse me. Sorry. What do you think are the 3 biggest problems that will affect the financial market in the future?
Can you please just repeat the question and just make sure?
What do you think are the 3 biggest problems that will affect the financial market in the future?
In the future or right now?
In the future.
In the future. I think we can take a poll, actually. Couldn't you? Why don't we take a poll? I think we have enough problems right now, let alone talking about it. But we could, yeah. I think what I'll do is I'll take a poll later. There was a question actually behind.
On the emerging risks side, you said that these were off the balance sheet. So could they be hiding something? The transactions, I mean.
Well, it's recorded, so it's not hidden. It's just that it's not. It doesn't count towards your total assets, for example. So it doesn't figure in your banking regulation, ratios, that kind of thing. So it's all there.
I think the audience just now meant if the system can be gamed, like using the toxic debts by banks to hide their liabilities and to increase the capital for gambling.
Well, I think it's different, actually. So I started off by saying that there are some lessons that we have to unlearn. One of the lessons that we learned very hard during the GFC was that credit risk comes back to bite you. Yeah, this is what Charles has taught us time and again. And that's why the focus on credit risk was very much part of the post-crisis agenda. Yeah. What we're seeing in government bonds, actually, so the stress in government bonds, the economic impact of a sell-off operates through very different channels. So, sovereign bonds, they're not subject to default, or at least not default in the usual way, right? I mean, theoretically, of course, governments can default, but that's very, very unusual. It's more that when they sell off, the yields go up. Now, and the prices fall. Now you might say, well, why is that a problem? If the prices fall, that's, it's good for some, it's bad for others. But remember what government bonds do. They actually form, essentially, they are the bedrock of the financial system. So every other instrument is priced off the government bond market. So, if you have a mortgage and there's a sell-off in the government bond market, your mortgage rates go up. If you're a company and you need to borrow, your borrowing rate goes up. And that's like, that's a huge tightening of monetary policy. It's a very tightening of monetary conditions. And it could have a very big impact on the real economy. So just because something is not subject to default doesn't mean that it's, free of risk. So I think that's probably the right way to pose, to actually, to pose the issue, actually. So even though credit risk is off the table, a well-functioning government bond market is absolutely essential because everyone's welfare depends on it.
Yeah. Okay. Yeah. Let's there back the person in the back, then person in the front, and then. Okay.
Thank you. Coming back to the point about, and it's a very intriguing point you're making about the connection between FX swaps and financial conditions. I'm wondering, is that sensitive to whether the FX swaps are a result of a primary acquisition of assets in the US or exposed hedging? And to the extent that there is a difference on that impact, just curious, how do you have good data on existing hedge ratios, or is there something that you would follow as a proxy for the extent that positions currently held are being hedged? Thank you.
Yeah. So, in fact, that's a really good question because I've been sort of a bit loose with this because FX swaps can grow for a number of reasons. So it could be that it could be a case where you're acquiring dollars to invest, or it could be that I'm exposed and so I want to hedge. So that exposed hedging scenario is typically a risk-off scenario, whereas going into the US on a hedge basis, that would be a risk-on scenario. I think what the evidence shows is that latter, that risk-on scenario tends to dominate. And that's why we have these aggregate kind of this aggregate position showing up as risk-on. Of course, if we had better data, more granular data, we could actually really sort of shine a light on this. But we are drilling up rather than drilling down. This is aggregate data, but still it's useful. I mean, I think it's only our data can tell everyone that it's 113 trillion, because the others, they can see the granular data, but they don't know whether this is 100th or 1,000th. You can see every detail, but you're missing the big picture. At least we can tell you what the big picture is, which is big. It's 113 trillion. On the hedge ratios, there are some data, and in fact, the official data providers, they actually do a very good job. In fact, the Ministry of Finance in Japan publishes very detailed data on this, and it's less well organized and less well, I guess, systematized than the other data, but it's something that we should keep track of. Now, the difficulty is this is an area where you have to bring market players that are not traditionally the ones that are regulated. So you would need to go and talk to pension funds. You would need to go and talk to life insurance companies. And you would need to, in fact, talk to some retail investors, who maybe have mutual funds. So I think for central banks and other regulatory authorities who typically deal with banks and other intermediaries, this is not readily available data. So it's something that we need to recognize as being a gap in our understanding. But if we had that data right now, this would be very useful from a market's perspective. But the guess would be that hedge ratios are very low right now, going into the recent events, because the dollar is very strong. And why would you hedge if you can gain from the dollar itself? And short-term rates in the US were quite high, which means that any yield you get would be paid for in the hedging cost. And so the hedged yields from the point of view of a Japanese investor or a Euro area investor would be close to zero. Yeah. And so you're better off buying a JGB or buying a Euro area bond. So this is why probably there's a lot of unhedged holdings out there. And that would increase the vulnerability to this kind of dynamic.
Following on from that question, do you think the private sector should be enforced to have like a minimum hedge ratio, or like be sufficiently hedged? Because I'm only asking that because in like Taiwan, for example, the private sector wasn't sufficiently hedged in their dollar liabilities, and now because of the movement in the US economy, the Taiwanese dollar has shot up in value because they all have to sell at the same time into that spot market. So do you think the central bank should enforce mandatory hedging ratios on all FX pairs?
So I didn't get the first part of the question, but I did catch Taiwan. Yeah, probably it's probably better not, for me not to talk about individual economies. But I think Asian investors in particular, I think there's been a lot of movement in the currency markets in Asia, and it's not unrelated to the fact that there are probably lots of holdings of U.S. securities in Asia, and for the reason that I mentioned just now, hedge ratios are probably fairly low. And I think this is something that we, we may come across repeatedly, at every time the market seems to, go into a bit of a stress period.
Here, in the front. Where's in the front? No, just. Okay. Richard, sorry.
Yeah. Can we look at discuss the relationship between this hedging activity and financial stability? Let's take the last episode of serious market instability, which was March 2020, where indeed the U.S. Treasury market froze up, and others as well. Would you say that a higher degree of hedging would have brought more stability to the markets, and would therefore the regulators should encourage as much hedging as they can possibly get from the financial institutions?
That's a very good question, Richard. And I think this goes back to what I was saying just here. So this is a story when you're fully hedged. So here's a euro area investor ends up holding a US dollar security, but there's an off-balance sheet dollar obligation, so there's no currency mismatch. You've completely hedged out currency mismatch. But there is a maturity mismatch because you need to either roll over the off-balance sheet obligation or find dollars. And what we found during March 2020 was that there was a big scramble for dollars during that episode. For the reason that you typically don't want to sell the assets themselves. It's a long-term security. You're going to take a big loss if you sell it. But you need to. So if you have to roll over that swap, you're going to have to join the scramble for dollars like everyone else. So in that sense, it's a bit double-edged. It's a bit double-edged. Yeah. It's a bit double-edged.
Person in the back. There. Where's? Okay. Yeah. Next one, please. Yeah. No. It's okay. That's fine. I thought it was. I saw this person in the back, and then it can be her, and then it can be here. Okay. Please go ahead.
Yes. Thank you. The dollar has been a great diversifier to most sort of traditional portfolios, riding into nearly every drawdown of this classic 70-30 portfolio, and partly was because people funded, in the liquid dollar markets and invested abroad. And I was wondering where there's a huge concentration to dollar assets, if you see the properties or the diversification properties of the dollar changing on a forward-looking basis.
Yes, that's a very practical question. So I guess when the dollar was strengthening, it was a very good hedging asset to have. So a U.S. fixed income security was a very good hedging asset in that in a risk-off episode, the dollar would strengthen. And in particular, in a risk-off episode, yields would fall. So you win twice. You win on the exchange rate and you win on the price of the instrument. So it's always a very good hedging instrument to have. Of course, that's a statistical hedge. It depends on the statistical relationship holding. And I guess, the issue is, will it continue to hold, right? In this ex-post hedging story, it clearly went the other way. Yeah, you had this triple decline of stocks, bonds, and the dollar. So I think whether it's a good hedging instrument or not really depends on whether the past statistical relationships continue to hold. And I guess that's something that practitioners will need to think about very hard when they form the portfolios. And indeed, the strategic asset allocation committees will need to think very hard about.
Yeah, person in the top balcony here. You have, okay, please.
Okay, thank you. Talking about the need of change in accounting perspective to put more like attention to FX swap, I'm very interested to the questions whether central banks could be the driver of these changes, because in the current situations, the bilateral swap lines between central banks itself are treated as an internal balance sheet reallocations, so the data are scattered because they are not obligated to publish the data regularly. But like at the same time, this bilateral currency swap by the central banks has been extensively used, especially by US and China in GFC and in China case in an attempt to de-dollarize. So what is your opinion on the role of the central banks in putting attention toward FX swap by setting an example of publishing bilateral swap line execution regularly? Thank you.
Well, this goes back to my, so the question is, what is the role of central banks in all this? This is, this is Charles's area. It's about money. And, there's central bank money and there's commercial bank money, and the two are very closely related. So, and central bank money is the base of the system. So, of course, it's going to be very important for that continue to hold, for that to continue to hold. Charles, what do you think about this question?
Well, actually, I was going to ask another question, or a slightly related one, which was you started by showing us the very high leverage ratio, and you implied that we were remiss by not taking that into account. In what way are regulators remiss now by not taking into account what you've been talking about? What ought regulators to be doing that they're not doing now? And I would end with one comment. You said credit risk comes back to hurt you. Surely with what's been happening, with the rise in the enormous amount of government bond issues, is that it's interest rate risk is going to come back and hurt us. And what should the regulators be doing about interest rate risk?
You always go to the heart of the issue, Charles. So Charles's question is, what are we missing? Well, if we knew that, then I think our job would be much easier. But I think you put your finger on it. It's, in answer to an earlier question, I said, default risk, credit risk, even in the absence of credit risk, a sell-off in the market can cause very big damage to the economy. If your mortgage rate goes up by 3 percentage points, I mean, that's a big shock, right? So if there's a big sell-off in the government bond market, that's going to impact the economy hugely, even if there is no default. Of course, there are the issues of fiscal sustainability and so on. So Charles, what should we all be doing? Well, in a way, the most difficult question is on fiscal sustainability, right? So this kind of chart is telling us that there's a lot of these securities out there, and it's being absorbed. So someone's buying them, and some economies have more room than others. I think we found out what the UK's room for manoeuvre was during the LDI episode. And I think what this chart shows is that the euro area has been doing very well in that sense, that they've already anticipated some of the limits and have been very conservative. It's, the red dotted line is actually below, it's the lowest of all these series on the right-hand panel. So I think, Charles, it's not about diagnosis and the regulators swooping in to stop something happening. This is a much more difficult question. It's about fiscal sustainability.
In terms of the size of yen carry trades, how much do you think was unwound last summer, and how much was like put back on, in terms of percentage?
Yeah, that's a. I guess we don't know for sure, but I think ex post we can try and piece together. So if you want numbers, I'm afraid I'll have to disappoint you. But I think we have a good sense of where the money went. So I showed you the sequence where you borrow yen and then you sell the yen and acquire something else. I gave you the example of an emerging market government bond. So let's go to the yen carry. So you borrow yen, but then you sell the yen and buy something else. So this is an example of carry trade. It's a classical carry trade. You bought government bond. You bought Brazilian government bonds, Mexican government bonds. That would be the classical carry trade. And we know which markets actually were the most stressed in the unwinding. So that's giving you some sense of where the money went to. But we can speculate as well. We can sort of try and read the prices and just look at the markets that did very poorly in early August last year. That's probably where the money went to. Yeah. There was one day when the Nikkei fell 12%. The Nikkei index fell 12%. Well, one way that could have happened is rather than holding it in a safe yen claim like this, you just use the yen to buy Japanese stocks, for example. So if that's what happened, then the unwinding would take that form.
Yeah. Sorry. Yeah, the fourth row, and then back to the person in the sixth row.
So why don't I sit down while I answer?
Yeah, and would be the last two questions maybe, and then we can.
Okay.
Thank you. Can I ask about counterparty risk in the forex market? You explained the market's got very huge, and we know that counterparty risk is important in the forex market. Have you got any thoughts on the potential for problems from the counterparty risk side, as we know that the global financial crisis started from failure of institutions? Thank you.
Well, actually, on counterparty risk, I think the thing to remember about FX swaps is that these are all collateralized. So essentially, what you're doing is you're providing one currency and acquiring another currency as collateral. Right? So this is. Remember this diagram. So when I lend you dollars, I'm holding euros, yeah. And as prices change, we would adjust the margin. So you are protected from counterparty risk to some extent. So it's not like sort of an uncollateralized lending, or just lending for mortgages. Whereas where you would have to repossess the house. So in that respect, it's probably not such a problem.
And okay, let's
If I understood correctly, otherwise please correct me. You said that when currency depreciates in value, FX swaps will increase. So what we've seen in recent months with America and a drop in the US dollar, would you expect the trend to continue with FX swaps increasing, or do you think the skepticism around the political situation will alter the situation, alter the FX swaps?
Well, I think the ex-post hedging idea, would back up that story. So here, I showed you this chart, the relationship between the dollar exchange rate and the FX swaps with the dollar on one side. There's a negative relationship. So when the dollar weakens, you would see more FX hedging. So when you go into the period with very low hedge ratios and you increase the hedge ratios, then that would be done through an increase in FX swaps. So yes, I would expect this to hold. Yeah. Very good.
I was planning. Can you handle it?
Sure, absolutely.
Okay, so let's take these two questions, and this will be our very last question. So, yeah, person in the... Yeah.
Actually, should we go upstairs? I see Freya, actually, so we could also go.
All right, fine. Let's take this question. Let's go upstairs then, and then you can take... Wow, okay, fine. Okay, fine. So let's start with this, yeah.
What would you say would be the impacts of the rise of central bank digital currency on the FX market?
So you're asking the same question as Brunello. Well, it depends on what form and what platform those are traded on. But actually, I've got the perfect answer. Just go and read the BIS Annual Economic Report, Chapter 3, 2021. So it's all about this.
Project Pine.
Project Pine is something that we announced last week. Yeah. That's more on tokenization and how you use it for monetary policy, collateral management, that kind of thing. But Fred, did you have a question?
Thank you. I just wanted to come back on the idea of where the risk is and whether it's only about fiscal sustainability, because surely a lot of this could be seen, a lot of the FX swap trade could actually be seen as the result of differences in returns between countries and risk-adjusted returns between countries. That's what's driving the portfolio flows, and the FX swap market could be the result, the gross flows there could be the result of those differences in returns, whether you look actually before the global financial crisis at that form of round-tripping or the form of round-tripping that you're identifying just now. And so maybe coming to the idea of what actually causes the differences between risk-adjusted returns in, say, Europe and the US. Maybe if fiscal policy had been looser in parts of without naming names, in parts of the euro area, then perhaps risk-adjusted returns and domestic demand in Europe might have been greater, and therefore portfolio flows from Europe to the US might have been less, and therefore this source of financial risk that you've identified as a cause of potential tightening of conditions on the real economy in the future, that might have been less.
Well, it's all, so there's a standard answer to this kind of question, Freya, which is to say everything's endogenous, because we're in general equilibrium. And I think it's true, actually. This is, it's all simultaneously determined. But what I just showed you in the time series is that, this market, the government bond market, is now the center of what, not only is it kind of, the bedrock where everything else is priced off, it is just the largest market out there. And so if the GFC was all about bankers, Fred Goodwin and the bankers, and the mortgages and so on, the protagonists now are portfolio managers, and there are many, I'm sure, in the room. So you're the main actors now. So it's the portfolio managers who are managing portfolios of government securities, bond portfolios of various kinds. You are now at the heart of the financial system, and the government bond market is the central arena now. And so when we tell the story of the GFC, and Charles and I wrote the Geneva report on this. That was very much the story of the run-up and the run-down. And Paul was actually also, very much part of the story. Yeah. But it's the market, it's the capital market, and in particular the government bond market. So, it's typically, we normally don't pay much attention to it because, it's safe, it's somewhat boring, but actually it's of first order importance. So I think, Charles, this is one of the things that we have to pay attention to.
I think that's a very good way to close the lecture. So I apologize for not... well, okay, we can maybe take it offline, the remaining questions. Sorry for not taking more questions because we really ran out of time. It's true that, I mean, thank you so much, Hyun. It was so interesting, your presentation, and actually leaves so much more to discuss. So, okay, so let's all express our thank you to Hyun.